Good afternoon. Thank you so much for joining us today for another episode of In the Know Live. Today's topic is tax reform and all of the effects that it's going to have on our ministers and churches going forward. Because of the detail included in this particular webinar, we have decided to go for an hour rather than 30 minutes. So we're going to try to cover just as much as we can, but our primary focus is going to be the impact that it has on our churches and our ministers. Again, we are privileged to have Art Rhodes, the president and CEO of the Church God Benefits Board, and he's going to help us walk through all the different impacts and things that are going to affect us with this new legislation. Art, along with his associates at the Church Benefits Association, worked ahead of time helping create this legislation and was a voice for our churches and ministers by going and talking with congressmen on the front end. And now that the law has been passed, he is still having communications through and with the Church Benefits Association, as well as the Church Alliance, to try and interpret what has been passed and give a better understanding and then explain those to our churches and our ministers. So Art, thank you so much for joining us today. It's such a privilege to have you, and I will let you take over now.
Well, I'm a little concerned the way you set that up because some of these things may not be so popular with folks, and I want to make sure that everybody understands we were having multiple conversations with literally dozens of members of Congress as this legislation was kind of making its way through the process over the last year. We were able to keep some things out of the bill that we were concerned about. Some things that we were concerned about stayed in the bill, and we'll talk about a few of those things. Some things that we would have liked to have seen included in the bill were not included. So what we're going to do today is over the next 45, 50 minutes, maybe a little bit longer than that, I'm going to try to walk you through kind of the major provisions of the tax reform bill and just talk about the big things. I'm going to talk about the things from the standpoint of the individuals and how that impacts them first, and then we'll talk about the potential impact that those changes may very well have on churches and other nonprofits. And I know we have a lot of church folks that have joined us today. We really appreciate you joining us. We had so much demand. We're broadcasting this webinar both through Zoom and through Facebook Live. And we appreciate everybody joining us. We're sorry we kind of ran out of space on Zoom, but hopefully for those of you who are on Facebook Live, you'll participate as well. I think you may have mentioned, but I want to just reemphasize, if you have questions for us, you can submit those by email to webinar@benefitsboard.com, or if you're on Facebook Live, you can certainly just type in a comment and we'll see that, and hopefully at the end of our time today we'll have a little bit of time to talk about it. But the Church Benefit Association and the Church Alliance, which are two ecumenical organizations representing about 40 or 50 denominations across the country, have worked on this legislation. And again, I've been on Capitol Hill multiple times over the last 12 months, talking with, again, probably 25 or 30 members of Congress myself on some of these issues. I will say that some of the things we talk about today are really not, we're not clear of what the impact may be. So there could be some radical changes, and we're already hearing. As a matter of fact, this morning I've heard from some folks who are talking about that there may be some clarification legislation that will resolve some of the concerns that we have about the legislation. So let's jump in, and you're going to see on the screen, we're going to kind of walk you through a PowerPoint presentation that will kind of give you some background of the tax reform bill and give you some basic information. I'm going to just tell you right up front, again, we're going to concentrate primarily on the issues that impact individuals. We're not going to talk about the changes in the corporate tax rate and some of the other bigger issues. I wish we had time to talk about the unrelated business income tax changes that were made in this particular legislation, but we don't have time for that. It would take us another hour or two. So what I want to concentrate on is the basics. Now, again, these apply to everyone, not just to ministers, not just to church staff folks, but these particular provisions apply to everyone, every individual out there. So let's jump in. You see kind of the beginning here. This legislation took effect, it passed in December, it took effect on January 1 of this year. And this is probably the biggest confusion because most people think that as they file their tax return now, they should be seeing some of these things take effect and change, but that is not the case. It took effect January 1, therefore, you will not see this show up on your tax return until you're filing your taxes at this time next year. So just remember that the tax tables and all that we're talking about, again, are effective now, but from a tax return standpoint, it will be your tax return next year, not the one that you're currently working on or have maybe already have filed. The other major point I want to point out is that this provision was done under what is called a reconciliation process. And that means that it had to, all the revenue and all the offsets that were done as a part of this legislation had to be done in a 10-year cycle. And actually, they did it in an 8-year cycle. So you will see, as we talk about this, most of the provisions will sunset or basically go away in December of 2025, including the tax tables. So we will revert back unless Congress acts between now and then, and I'm pretty sure they will, but unless they act between now and December of 2025, those provisions and all the provisions that we'll talk about today are most all of them. There's a few that are made permanent, but most will sunset or basically revert back to the previous law that was in effect in December 2017. So just remember, this is really an 8-year tax bill, unlike previous tax legislation that we have seen. So with those 2 points in mind, let's just kind of jump in, and I'm going to go real quick, hopefully. For those of you who know me well, I don't do anything real quickly, but we'll go as quickly as possible talking about some of these different provisions. So first of all, here we still have 7 tax brackets. We had 7 before, we have 7 now. The difference is that those tax brackets and the dollar amounts have changed just a little. The low tax bracket is still 10%. It was 10% before, it's still 10%. But the highest tax bracket now is 37% rather than 39.6%. And just to give you an idea, I'm going to have put on the screen just kind of a comparison between the tax brackets for a married taxpayer filing jointly. And you see there still a 10% bracket, but now the 15% bracket has now become 12. And you see the different brackets as they go down through there. For most everyone, their tax bracket has decreased. If you're in the $400,000 range, your tax bracket probably stayed the same or potentially went up a little bit. But for most everyone below that, you have seen a decrease in your tax bracket beginning as of January 1 of this year. And again, this is the bracket that you're seeing there. The comparison is for a married couple, married taxpayers filing jointly. And you'll see a couple of things listed down at the bottom. The standard deduction has gone to $24,000, but the personal exemption has gone away. We're going to talk about that in just another few moments here, because that is critical information as you look at this whole process of tax reform. But Again, if you're single, there's a different tax bracket. If you're head of household, there's a different tax bracket, as you well know. But I just wanted to give you an example here so you could kind of compare in just a moment of where you might be if you're in a married filing jointly situation, or basically in most family situations. So I mentioned the idea of this standard deduction and the personal exemption. The standard deduction, there's been a whole lot of conversation about this, and you've read about this multiple times in the newspaper, that the standard deduction has jumped from $12,700 up to $24,000. If you are a single taxpayer, it jumped from $6,350 to $12,000. So almost a doubling of the standard deduction. That's very positive from the standpoint that fewer people will have to itemize their tax return going forward. But as we'll see in our later discussion, that also could have a tremendous impact on charitable giving. And we'll talk about that at length. But if you think about most people who have itemized, and again, as we talk through statistics today, there seems to be a different take in almost every situation. There's a different statistic for everything, but the most common example has been that people who have itemized up until this point over the last few years are generally itemizing about $21,000 of itemized deduction. With that being the case, now with the standard deduction being $24,000, those people have no incentive to itemize anymore. There's no need to itemize because they're getting more from the standard deduction than they were before. And again, that's going to potentially have an impact. And I will say potentially more times than you can imagine over the next hour, because a lot of the things that we're talking about today, again, from the standpoint of the possible impact, we really don't know what's going to happen. We are trying to make some good educated guesses as to how that will impact our giving, both to churches and other nonprofits. But the bottom line is, it's almost, we got to wait and see what happens. But the standard deduction in every case has almost doubled. Now, the other point that you see there is that the personal exemptions have been eliminated. So let's just take a quick example. If you had a husband and wife and 2 children, you've got a personal exemption for each one of those folks. So 4 personal exemptions, that's $16,200. Under the old rule, you had $12,700 worth of standard deduction. So just with those amounts there, you were at what, $28,900, almost $29,000 worth of exemptions / deductions. Now that is $24,000 rather than almost $29,000. So most people will say, well, it's a $5,000 reduction in that situation. However, as we move on to talk about the next issue, the hope was made up there that the child tax credit would be enhanced and therefore equalize that reduction. And then with a reduction in the tax brackets, it would be better for most people. So with the child tax credit, and you notice that we say it was enhanced, historically, since the last tax reform, the child tax credit was $1,000. And now under the new tax reform legislation that's in effect now, that child tax credit has been doubled to $2,000. And in addition, $1,400 of that $2,000 could be refundable. So it basically creates kind of an earned income tax type credit where it could be a refundable credit back to a family based upon the number of children. Again, the idea was to neutralize the elimination of the standard or the personal exemptions. Now, interestingly enough, we'll talk about later in our discussion, you base your W-4s that you file with your employer and how much withholdings you get on personal exemptions. Those have now gone away. And we'll talk about the new W-4s that have come out in just a moment. Next issue you see is what has been called the SALT deduction. This is for state and local taxes. In states where there are huge property taxes, particularly along the West Coast and the Upper East Coast, where property taxes are really, in some cases, very onerous to folks in how much they are. Those people are going to be impacted by this limitation, because under the tax reform bill, the SALT deduction, or the state and local tax deduction, was limited to $10,000. And so now that deduction would come on your Schedule A as a part of your other itemized deductions. So you now have a limitation that you can only claim $10,000. For most people across the South and kind of the Midwest, this is probably not a big issue, because your state and local taxes most likely are not going to exceed $10,000. But for some of our ministers and church folks out there, and particularly other givers, this is going to be a very large limitation on what they can deduct from their state and local taxes. Just another kind of a limitation is what you see now on your screen, and that is mortgage interest deduction was limited to acquisition indebtedness. And I want to make sure we use those terms, but was limited to acquisition indebtedness of less than $750,000. That number had previously been $1 million. So let me just quickly try to explain that. If you were purchasing a home that was worth $1.5 million, but you borrowed $1 million on it, you could claim all of the interest deduction on that $1 million previously. Now you can only claim up to $750,000. So it doesn't matter the value of the property, it matters how much indebtedness is on the property. And again, it has to be for acquisition or improvements. And that brings us to the next point, and this is a huge change, and that is that home equity interest deduction has been eliminated. Now, let me just stop and dwell here for just a second on this. We've seen a lot of our ministers and other church-related employees that have used home equity loans to buy a new car, because they could count the interest off on their taxes by doing that, where a consumer debt, you could no longer claim those interest payments as a deduction. So people have used those home equity loans to go out and buy a new car, maybe even go on vacation. What is now happening under the tax reform bill, again, effective January 1 of this year, is that you cannot use those home equity loans in that manner as an interest deduction. Now, again, if it is used for acquisition indebtedness, so if you use that home equity loan to improve your home and you can show that it was used for improvement, all of those things, that it's improving your residence or maybe even a second home, then you'll still be able to claim that. But if it's been used for other purposes, you're not going to be able to claim home equity interest going forward. Previously, that was a $100,000 amount, but that has now been eliminated under the tax reform bill. I guess our next topic here is probably the biggest concern that I have for ministers, and that is this idea that ministers under the new ministers and other business people under the new tax reform bill can no longer use miscellaneous itemized deductions because that has been eliminated. So if I've put on here kind of the bottom of the current Schedule A from the 1040 situation. So let me just talk about the first issue that's on there. Casualty and theft losses, I don't have a bullet point on that, but you see it on your screen there in the little insert. Under the tax reform bill, casualty and theft losses have been changed too. Previously, if your house burned or something of that nature, you could claim that as a deduction on your tax return. Now, you can only do that. You can only claim a casualty or theft loss if that area was a part of a natural disaster proclaimed by a presidential declaration. So if you're in a fire area or something like that, your house burns, and it's a presidentially declared declaration on that emergency, you'll be able to claim that. But if you're just, something bad happens and you have an electrical fire and your house burns down, that loss can no longer be claimed based upon the new tax reform bill. So just this quick side note on that. But the bigger issue here that I want to talk about is this unreimbursed expenses, unreimbursed business expenses for ministers. And what we have seen happen is ministers have not wanted to have, in some cases, for one reason or another, have not wanted to have an accountable reimbursement plan. So what they have done is throughout the year, they just keep up with all their business expenses. They're getting a salary from the church. They're going on about their business. And at the end of the year, they got this stack of receipts. That stack of receipts shows all their business expenses through that year. And what they do is they take their W-2 from the church, they take their stack of business receipts to the minister, and at that are their receipts from their ministry income to their tax preparer at the end of the year and say, here's all my receipts, here's my income. And what happens in that situation is that the minister has been able to take those issues, all those business expenses off of his tax return here on Schedule A as an unreimbursed business expense. And there was a 2% issue there. It had to be over 2% of your adjusted gross income, but they were still able to claim that. All of that has been eliminated as a part of the tax reform bill. So if you're a minister out there and you've been doing that, or if your pastor does not have, if you're a church treasurer and your pastor does not have an accountable reimbursement plan, you need to look at this immediately, because all of his expenses up until this point cannot be claimed on his tax return when he files his tax return after January of next year. This is a major issue, and a lot of accountants out there are running programs that says, how would, if you had the same income and everything next year under the tax reform bill, how would it look? And I've had conversations with some of those ministers who've had that run where they were using unreimbursed business expenses on Schedule A, and this has changed their tax liability by literally thousands of dollars. So you need to be very cautious about this. If you need to set up an accountable reimbursement plan to deal with this, go to our website at benefitsboard.com, click on resources. When the resources tab comes up, there's a list of things there. Go to manuals, church manuals, and there's a manual for church treasurers. There's a manual for ministers' compensation. And in both of those manuals, you'll see the process of setting up an accountable reimbursement plan. But this is something that you need to deal with now to make sure that your minister doesn't get in a situation where he has a lot of deductions that he's unable to claim. Let me just hit upon a few other issues. This next issue is one, as we were talking earlier, I told Angie we would take credit for some things and some we wouldn't. This issue about living expenses is one that we had multiple conversations with members of Congress about. And that was because ministers are impacted by this. Previously, a church could provide for the moving expenses of a minister, and that would be a non-taxable event. Or if the church did not provide for the moving expenses, the minister could pay for his own expenses and then claim that as kind of a above line deduction. That has gone away. The tax reform bill has eliminated that. The only folks who are eligible to participate in this moving expenses like before are military people. Everyone else is now, if the entity, the church or employer pays for the moving expenses of the employee or minister in our case, then that becomes taxable income to the minister. If they don't, and the minister, again, in our situation, has to pay for his own moving expenses or her own moving expenses, then it's no longer deductible. So it's kind of a double whammy here, a double hit. And as we've pointed out here on the slides, there is no exception for overseas transitions. So for a missionary that's moving to some foreign land, that exception does not exist anymore, or potentially maybe one of our ministers moving from one of the 48 states to Hawaii or Alaska. This exception does not provide anything that would allow even those transitions to happen and it be tax-free. A couple other quick things. Section 59 plan, 529 plans. You've probably heard of these. 529 plans are basically college plans, where a college savings plan where you could put money aside. It grows tax-free. You don't get a deduction on putting money into the plan, but it grows tax-free. You don't have to pay taxes on the earnings, and as long as those funds are used for college education, then it's tax-free distributions. Well, under the tax reform bill, the 529 plans were expanded to include elementary and secondary education. So for those of you who have church schools or private schools that are associated with your church, this becomes a huge advantage for you, because under the tax reform bill, a person could draw out of that child's 529 plan up to $10,000 a year to use for their elementary and secondary education. Now, there's all kind of discussion about this, of whether that's a wise idea or not, but it is made available under the new tax reform bill. I'll just briefly mention this idea of alimony, and this is just kind of something we don't like to talk about, divorce and other things in the church world, but it occurs, and this is a substantial change in the law that impacts alimony. This provision does not take effect. It is not effective yet. It does not take effect until the end of 2018 and going forward, just because of the impact of this. But previously and currently, I guess we should say, a payor of alimony has the right to deduct the payment of that alimony on his or her tax return. However, the recipient of the alimony has to claim that as taxable income. So whoever is receiving the alimony, it becomes taxable income to them. Effective January 1 of next year, that whole process changes. Alimony will no longer be deductible by the payor, nor will it be treated as income to the recipient of those funds. And there's a huge tax advantage of changing this, actually a tax revenue issue where the government's going to pick up literally tens of millions of dollars a year, because what has happened is, for instance, if a person, just to use a large example, if a person was paying $100,000 in alimony and they were in a 39.6% tax bracket, in reality, that $100,000 was only costing them about $60,000. Now that $100,000 of alimony will actually cost them $100,000 because they're getting no tax benefit out of that. And there's a lot of folks in the legal community that are concerned that this may actually lower alimony payments because there's not the tax advantage of that. So this could impact people in your church, again, who are givers in your church and are contributing to your offerings and to your nonprofits. The very last thing I'll talk about before we transition into some of the impact is the Affordable Care Act was addressed in the tax reform bill. As you know, the Affordable Care Act, most people call it Obamacare, but it has two different provisions. One is it's called the employer mandate, and it says that any business that has more than 50 employees must provide insurance for their employees. And then the second provision says that if you're an individual, you have to have insurance yourself. So if you're not working for one of those employers that is required to provide you insurance, then you have to go out and get your own insurance. And there's penalties on both sides if you don't comply with the law. And under the second provision for the employee, it was called the individual mandate, and it was about a $600, almost $700 fine. And that fine was for individuals, and it went up to 2.5% of your income. So it could expand up into the thousands of dollars if you did not have health insurance. Well, the tax reform bill didn't eliminate that provision, but it permanently reduced the fine to zero. So while you're supposed to still have insurance, it's now a zero penalty. And so again, the impact of it, it's like, okay, you're not supposed to speed, but if you do, we're not going to charge you a fine. That's kind of the analogy here. But I would just point out that this is another one of those provisions that does not take effect until January 1 of 2019. So for this year, for 2018, you still have to have coverage. If not, you're subject to that fine. So Angie, with that discussion, that kind of gives us the broad overview of all of the different tax provisions. And that's probably, I think most everybody's probably asleep by now. They may be watching us, but they're dozed off unless they had a whole lot of coffee when we started.
I think our participants are paying attention because you're talking about their liability and what they're going to owe in taxes at the end of the year, and everybody wants to know how to reduce that and make sure that they are doing everything right and that they can decrease their liability as much as possible. So I think they're all with us, and I appreciate so much everything that you've shared with us.
Sure.
I would like to know, now that we've talked about all these deductions and that liability, what is the potential impact that it may have on our churches and other nonprofits as well as charities? Have you had discussions with your partners about those kinds of things?
Well, I have, and I guess this is probably where I'm most concerned about the impact of the tax reform bill. So let me just kind of walk through again some of the issues that I think that we need to be concerned about as we talk about this whole idea of tax reform and the issues of the potential impact that it may have on churches and nonprofits. So I think there's at least three factors that we have to consider right up front. The first is this whole idea of a higher standard deduction. As you recall earlier in our discussion, I said that most people that itemize, the average has been somewhere around $21,000, according to the IRS and other people who have looked at this. Well, now the new higher standard deduction for that married couple filing jointly is $24,000. That means that that itemizer who has been itemizing under the standard deduction or the standard itemization at about $21,000 has no need to itemize anymore. And what does that mean for charitable giving? It means that I'm going to get $24,000 worth of a deduction, whether I give $1 to a charity, or whether I give $1 to a church, or whether I give $1 to pay for state and local taxes. I'm still going to get $24,000. So if that 21,000 was the average of itemizers, having a higher standard deduction does not incentivize me to give anymore. The other thing is now there is a restriction on itemizing deductions. When we talked about the SALT or state local tax, it's now limited to $10,000. There's the miscellaneous deductions went away. And so when you begin to put all of these factors together, the restrictions as well as the higher standard deduction means that there's going to be less people itemizing, therefore less people incentivized to give. And then that brings us to the other factor I think that we have to consider, and that is a lower overall tax rate. You don't think about this, but as the tax rates are higher, it incentivizes people to give because their giving doesn't cost them as much. We kind of talked about that a while ago a little bit with the alimony. It's the same impact of giving. If I'm in a 39% tax bracket and I give $100, that $100 is not costing me $100 because I'm getting a deduction of 39.6% of that 100. So it's costing me again about $60 to make a $100 deduction. But if I move that tax bracket from a 39.6 down to a 33% tax bracket, now it's costing me $67. So every movement, and while that may not seem a lot, for a lot of givers, this is going to make a difference. Now, I want to reemphasize what I said earlier, and that is we're basing a lot of what we're talking about on speculation. But the speculation is throughout the charitable community. We're looking at this, trying to figure out what is going to be the impact. So let me just take just a few moments and give you some sources that we've looked at and kind of what is going on with them and what they're saying. The first one, and I purposely put this this information first in this discussion because this is very telling. I continuously hear from our pastors that say, you know what, people don't give to our church because they get a tax break, they give because they love the Lord. And I agree with that 100% for those people who are giving on a regular weekly basis. Some of those may get no tax benefit at all from giving, but they're giving because they've been taught in Scripture that they should give, and they want to be good Bible-believing, Bible practicing folks in their giving efforts. They're following the guidance that's found in Malachi and other parts of the Bible to give, and you're going to be blessed, and they're giving a tithe, and they're giving offerings, and they're giving other things. However, the statistics here are startling. And Charity Navigator points out that 31% of charitable giving occurs in the month of December. 12% of all giving, not 12% of that 31, but 12% of 100% of all giving given in a year occurs on the last 3 days of the year. And some of you who are watching and listening know that you were just like me. On December the 31, I was sitting with my laptop in my lap making contributions to charities that I support. And was I doing that because I love those charities? Well, yes, I love the charities, but I was doing it also because I knew that I was going to get a tax break from doing that. And I also knew of some of these things were coming in the new tax law. So if you think about almost a third of the giving is given in the month of December, if we were to lose even that 12% at the end of the year, think about what impact that would be on your church's budget. So if your budget is $100,000 a year at your local church, what would you do if that budget went down to $88,000 a year? And I think that's what we have to think about. Let's look at another statistic. This comes from Inside Charity. Under the new tax reform bill, they are now estimating that the number of itemizers, or the folks who itemize their tax return, will drop over 56%. So again, we're getting close to almost 2/3. It will drop from 37 million people itemizing to 16 million people, or from about 30% of all taxpayers down to less than 10%. I have seen some statistics that say that number of itemizers could be as low as 5%. So if you think about that, let's just say it is 10%, 90% of all of us will not be itemizing. And therefore, again, as I pointed out earlier, 90% of us will not have an incentive to give to our local church, or give to our local United Way, to give to our local American Cancer Society, to give to Boy Scouts. Name the charity out there, you will find that 90% of the people may not have an incentive anymore to do that. So startling numbers again. But let's look at this one even more. Overall charitable giving could decline, and this is from the Lilly. It's actually the Lilly School of Philanthropy at Indiana University has suggested that giving could decline between 1.7% and 4.6%, or $5 billion to $16 billion, just as a result of the higher standard deduction. Now, again, I've seen other numbers, and there's other folks out there who have done studies that say that on the low end, this is a $5 billion problem, but the high end could be much more than the $16 billion that the Lilly folks came up with, that number could approach 25 to $30 billion. Now, when you think about that, of all charitable giving that was given in 2016, there was about $390 billion given that year. And when you consider those numbers, if you lose, again, 20%, or if you lose $20 billion, $25 billion, $30 billion off of that number, that's a huge, huge number. Now let's just think, while we're at this slide, let's think about this for just 1 second. If you look at the folks that make less than $100,000, about 2/3, about 65, 66% of their giving is going to churches. Interestingly enough, the folks who make over $1 million a year, have $1 million worth of taxable income a year, less than 1/6. So roughly 17% or so of their giving goes to churches. That's a big difference. So if you look at the demographics of your church, if you got higher wage earners, you're probably getting a lesser percentage, but most of our folks in our churches are going to be those $100,000 family wage earners and under. Again, 65, 66% of their giving is going to churches. And if that number begins to get tighter and tighter, our churches could see some real struggles. So I guess our next question that we have to ask ourselves, and that is, well, what can we do? Or what should churches and other nonprofits be doing during this time to try to squelch some of these issues? So let me just walk through a couple of suggestions and thoughts and just kind of follow up on what we've already said a little bit as we kind of wrap up our whole discussion today. First of all, as we've already said, about 90% of taxpayers are not going to get any benefit from their charitable giving under the new law. because they're not going to be itemizing. They're going to get that $24,000 standard deduction, whether they itemize or not, whether they get, they're going to get $24,000 whether they give $1 or not to a charity. So, or to their local church. The question is, will they give anyway? And we talked about that just a moment ago, and that is, yes, they probably are going to give those regular contributions throughout the year, but the question is, are they going to give those extra contributions that may be going to your building fund, to missions, to other things at the end of the year, or maybe even extra gifts? So we got to be really diligent in watching what's happening. One of the things that we suggest is that you create a kind of a matrix of how your giving has come in over the last few years and start very closely tracking that going forward. I would get at least 3 years of giving and do it month by month and say, okay, in January of every year, we've taken in $10,000 a month or $25,000 a month. And this time we only took in 8,000 or 23,000, or we may have taken in 28,000. What's impacting that? And where is that coming from? But you need to be on top of this. You don't need to wait to the end of the year and realize that you've come up 10% or so in your budget. Now, let me just point out on our next slide here, just some things that you need to be aware of and maybe even concerned about. Again, over the last few months, since the tax reform bill has passed, we're now into about a little over about 3 months, I guess, of this thing being in effect. I've participated in a lot of meetings and a lot of discussions and a lot of different discussions with different folks, both in the secular world and in the church world, about how we deal with some of these topics. And what we're seeing from the what I would call the CPA world out there, the secular world, is they are advising their clients, and again, these are generally the folks that have household incomes of $50,000 and up, and it could go way up, but they're advising their folks to look at the idea of bunching. That's their first concept. And what bunching means to them is that basically you save up your contributions. So for example, let's say you've been giving $12,000 a year to your local charities and churches, and your other deductions have amounted to $10,000. So you've got $22,000 worth of itemized deduction, basically what the national average has been. Well, now that $12,000 worth of giving to your local church is not benefiting you anymore. So the idea of bunching is you would just take your $12,000, set it aside in a savings account. And so this year you would just claim the standard deduction of $24,000 and move forward. But then next year you would take your $12,000 that you're going to give next year plus the $12,000 that you set aside. You would then give it to your charity, plus your other deductions. So again, let's say those are $10,000. You've got $24,000 worth of charitable deductions plus $10,000. So your total itemized deductions now are $34,000, making it worthwhile to itemize versus you're claiming the standard deduction. Now that sounds really good. The only problem is that first year the charity or the church is not getting any money. The money is not coming into them, therefore they're having to wait till next year to get their money. That creates a cash flow problem. Just because you think you're going to get it next year, don't mean you can spend it now. So from a church budgeting standpoint, that's a real challenge, and it's something that you need to be aware of, that there are a lot of the large firms out there, large CPA firms, and even the smaller ones who are advocating this idea of bunching for their folks who would be on that line in kind of the example that I use. It's going to create a challenge for churches. The other issue here is a lot of those same folks were advocating that you give in December all your contributions for 2018. If your contributions went up substantially in December, you may not be seeing that person give now, and they may not give this whole year. So you need to be aware of that as well. The second issue is donor advised funds have become a huge, maybe vehicle is probably the best way to say it, a huge vehicle to deal with this charitable giving situation. And what it does is allows you to give money into a fund and then later designate where that money goes. The problem with that is generally that's been for large contributions. It's generally been $50,000 or so. I have seen recently where there's a couple of firms that are offering donor advised funds for as low as $5,000 worth of donations. So that means that most anybody that's been itemizing could participate in a donor advised fund. You just need to be careful because those contributions go into that fund and they may end up going to some other charity rather than your church. So you just need to be aware of those, do a little bit of reading on donor advised funds. Now, let me just go back before we move forward and talk about this bunching idea. And we've had discussions even here in our office about this. And that is, well, I put my money from this year, my $12,000 in my example, I've put that into my savings account and I'm continuing to put $1,000 in there. I think a bigger concern is not necessarily the whole idea of our churches not being able to get that money in a regular basis as they've been doing. I think a bigger concern is that person who set aside that money may say, you know what, I deserve a nice vacation, or I deserve a new car. And I've got this money set aside over here, and the Lord probably wouldn't mind if I just went ahead and used that to go on a nice trip, to Hawaii or somewhere. I think that's a real problem. And when people have excess cash setting aside that's just kind of undesignated there, they may have the best intentions at heart. But in reality, when that money is available, they may ultimately use that money for something else. And that creates even a bigger issue for charities and nonprofits. So let's conclude here with a couple quick things. First of all, a lot of our churches have been seeing what I call a December bump. And that means they may be taking in $10,000 every month until they get to December. And in December, they may take in 50, 100% more. They may take in $15,000 or $20,000 in December. And it goes back to that slide that we talked about earlier, where that 31% of giving is given in December. I would just suggest that if you are in the church world, you do not budget for the December bump going forward. You may get by with it this year because most taxpayers are not going to be aware of how these rules are impacting them during 2018. But I would suggest by the time we get to December of 2019, you better be budgeting that month to be a flat month. And the final thing I would point out here is know the reason for a decline or even an increase in your giving. It may not be because of the tax changes. And I think that is critical to say, because as I mentioned earlier, you should be tracking month by month what your giving is and how that has changed from one year to the next. But there's a lot of things out there that we're seeing right now that are impacting giving, both positively and negatively. Number one, the new generation of givers, the millennial generation that's coming along, are very cause-oriented. They're not giving to just pay the light bill. They want to see what their money is doing, how it's working, what's happening to it, and they want full and open transparency and accountability. And if you're not doing that on the church level, I can almost guarantee, and that's a big statement, but I can almost guarantee that you're going to see your giving decline. Because with this new generation of givers, they want to know where that money is going to, how it's being spent. So you need to really check in on how those, how that giving decline is working and what's causing it. So let me give you some quick resources, and then we'll have just a few minutes for questions here. The first resource, and we've put this out in different publications already, and this is available to you on our blog site and our website. But the first is that on January the 11th, there was a IRS notice that was released that was notice 1036. You see the website there. This was the new withholding tables to implement all these changes. They promised at that time an online calculator. That was released on February the 28th. You can see again the link there. And I would just tell you, the online calculator, I've tried to work through it and with my own salary, and I tell you, it's a challenge. You need 2 or 3 CPA degrees to be able to work through that, but it is available for you as an employer or as an employee to try to make sure that your withholdings are pretty much in line. Just remember, on the online calculator, if you have been used to getting a refund, the online calculator is not taking that into consideration. They're trying to make it a wash, where what you're paying in taxes and what at the end of the year, you're as close as possible to not getting a refund or not owing taxes. So if you do the online calculator and it says you need to change your withholding so they are taking less out, you just need to remember, if you're used to getting a refund, you need to be aware of that it's not taking that into consideration. Finally, I would just point out, and I know some of you said amen to that, but finally I would point out that also February the 28th, the IRS released the totally new revamped W-4 forms. Do not go out and start having all your employees fill out the new forms. The IRS says you don't have to do that, and further, they said that these forms may change again before the end of the year or even into the first part of next year. I would just point out that the old W-4 form and this is basically determining how much withholdings you have. The old W-4 form was a 2-page form. Now the new form is 4 pages, and the 4 pages, 2 of those 4 pages are absolutely calculations. So, and I would just say, God bless you. Again, you need to hire you a couple of CPAs to help you fill that thing out, because it is a bear. And I tried to work through it myself and literally just got totally frustrated. So good luck on that. But you do have to use the new W-4 if you have employees that have a change in circumstance. You have new employees. A change of circumstance would be birth or death in the family that would impact the withholdings. Marriage, any of those things would be something that would change the W-4. You have to use the new form, but I would not recommend changing that for your current employees. You just got to watch for over withholding or under withholding. That's my last big point here, because under the new tax bill and under these calculators, you could get in either situation. If you over withhold, you're going to have some employees who are upset with you because they paid too much taxes. If you under withhold and they get to the end of the year and they owe a couple $1,000s, they're going to be upset with you too. So this is a tightrope that you have to walk. Now, I'm going to leave up on the screen some resources. If you have not looked at our website, it's listed there. And I'm also providing to you the ECFA, the Evangelical Council of Financial Accountability website. They have a website called Church Excel. On Church Excel, you can get all kinds of documents and other information. So I would encourage you to go there. Well, Angie, I have about talked out here. Do we have any questions? Please tell me no.
We do have several questions.
Okay.
You have been so thorough, but as it always happens, everybody has their individual circumstances.
Okay.
Do we have time to take just a couple of quick ones?
Let's take a couple of questions.
Okay, the first question we have is, what if your HELOC functions as your primary mortgage? How does that affect your interest deduction?
Well, a HELOC is a home equity loan, If that home equity loan is, number one, secured by the real estate, and number two, it is your mortgage on the real estate. It was used for acquisition indebtedness. If it was used for acquisition indebtedness, then you will be able to continue to claim that interest. However, if your HELOC you got a mortgage on the property, but you use that money to buy you a new Lexus, you can't claim it. So you've got to tie the use of the HELOC or home equity loan in our line of credit into the house and the acquisition or the improvements, construction or acquisition of that house.
Okay, thank you. Another person asked, you talked a good bit about alimony, but they want to know if child support is affected.
Child support was not addressed in this legislation. I can answer that one quick.
That
Let's
was
move on.
nice and easy. Well, let's take one more. This always comes up. Has there been any change to the housing allowance based on this legislation?
Absolutely no mention of housing allowance, ministerial housing allowance in this legislation at all. However, just a quick update on the housing allowance. Back last year, the judge ruled in December, well, earlier it ruled in October that the housing allowance was unconstitutional, and then issued a final order in December that basically said the housing allowance was unconstitutional and that she was entering an injunction to prohibit the IRS from allowing the housing allowance to be used, but that injunction was placed on hold or stayed in legal language for a period of 180 days pending all appeals being exhausted. And so in February, the case was appealed. It's before the 7th Circuit Court of Appeals now. You can find information about that on our website. We're keeping, again, under resources, you'll find the ministerial housing tab. You can click on there and see the latest information. You can actually even read the opinions. If you want to be more bored than you've been in the last hour, you can go and read a 40-something page opinion on the housing allowance. But for right now, everybody should just keep using the housing allowance as they've been doing it. The case is making its way through court, and we probably will not have a decision from the appellate court until the end of this year, first of next year. I would anticipate that would then get appealed to the Supreme Court. Either way, the court rules. And if that were to happen, then that time will expand more.
Well, we have gone well over our time, so we'll go ahead and wrap it up now. Thank you so much, not only for taking time to provide these resources, but to take your time to explain it. It makes it so much easier to understand and comprehend sometimes when you can just hear it. And we really do appreciate your time and information today. And we want to thank each of you for joining us today as well. As Art has mentioned a couple of times, all resources are available on our website at benefitsboard.com. And you can also email your questions to us at webinar@benefitsboard.com. Thank you so much, and I really appreciate it.
Thank you. If you have more questions, let us know. We'll be glad to help. Hope this has been helpful to you. Again, just from the standpoint of the potential impact, we don't know what that's going to be, but you need to be prepared. And hopefully we've raised some issues today that will help you to kind of think through what you do on a day-to-day basis. So if you begin to see changes, you can begin to implement changes. That's the critical part.
Thank you. And thank you for joining us.